Hey everybody, it's Sunday, March 8th, 2020, taking a look at the S&P 500 as we get ready to trade March week 2. We have ES contract rollover coming our way at the end of this week when futures reopen on Thursday night. We will be looking at the June contract on most brokerages. That will be automatically rolling over the symbol. And a lot of people will begin making their decision as to whether they're going to continue trading June once volume starts to become more heavy in the June contract. Usually by Monday at the latest, most people, except a few smart-ass know-it-alls on FinTwit, will be trading the June contract and not the March anymore. So if you're an ES trader, please, be aware of that's coming this week. And don't be the guy that gets trapped in the old contract and has to sell it at a low price and buy and pay up through the nose to get into the June contract. Okay. Anyway, here is my 6-up grid that I always have on hand during the day. It's a little bit pulled out of shape here so that I can show you a bigger shot of VIX futures. This was a big clue on Friday at the end of the day. In pre-market, we had only been trading at around 30 and maybe taking a little look above it, above 30 this week on VIX futures. But then on a Friday, once we opened, the VIX rose way up, and by the end of the day, around 3 o'clock Eastern time, it took a look above 40, and then literally after 3 o'clock, it began to roll over. And once it printed this first red candle, you can see the volume really popped underneath. This is why I watch VIX futures and not just a VIX chart, so that I can see volume bars on it. Volume really popped and pressed down, and sure enough, we were rallying back on the day. Just an amazing move at the end of the day, and it was clued in by watching the VIX here. This gave you a heads up as to whether you should still be holding your puts or maybe at the very least buy a few calls to protect yourself and hedge those puts. Anyway, that's what was going on there at the end of the day. All right, here is our close-up of our roadmap. Our main points right now, as we traded on Friday and as have been working for us in the past, 29.54 and 29.74. 29.54 is our 2020 closing low. That's where we closed here on Friday, the 28th. On the day before that, coming down, the second to last trading day of February, we came down and closed just above 29.74, gap down open on Friday the 28th, traded off all the way down to what is our 2020 low at 28.55 and came back to close the day on 29.54. Then when we came into the first day of March, we opened on this 29.74 level and rallied up. And then the next day and all the rest of the days of the week, we did not breach this 29.74 level until we got to Friday. And then on Friday, we opened on our 2020 closing low where we had closed the previous week. We explored and traded down below it. And at the end of the day, we came barreling back. And we were, at a couple points during the day, we were back above 29.74. But at the very end of the day, we traded well above it, but then fell back and closed just a hair underneath 29.74. I would tell you that had we closed and held that close above 29.74 on Friday, I would say without a doubt, no matter what you saw on futures overnight on Sunday, we would be coming in and taking a run at this 10 200-day simple moving average cross that's hanging over our heads. I would have said for sure, but unfortunately we lost it just by a couple of points into the close on Friday. And then after the close on Friday, we got news that confirmation that South by Southwest was going to be canceled. And that's going to be a big deal. That's going to be a big thing playing over and over again in the news loop on Monday. Okay. Another thing that is going on are our confirmation patterns. Here was our first break of the 200-day on Thursday, February 27th, and we followed through with a close below it again on Friday to end the month of February. But then the first day of March, we rallied back and closed well above the 200-day, the next day back below, the next day back above, the next day back below, and then Friday we followed through with another close below. So we've got two sets of Thursday-Friday pattern here where we have 2 days closing below the 200-day simple moving average. So on Monday, if we close below it again, that is a third day of confirmation, and that could be our clue that the institutional support is not in there to try and fend this off and prevent a double, if not tripling down of the move we've already made from the high to the 200-day simple moving average. And that doubling down from here is going to take us to 2709. A tripling down is going to take us all the way back to 2360s. That would take us all the way back to where we were in December of 2018 at the multi-year lows. Where do I come up with this doubling and tripling? Okay, here are the past two 10 200-day simple moving average crosses. The reason why these are so important is because the 200-day line, as per the article that's in the blog that explains SMAs, if you've never read that article to this point, I don't know what you're waiting for, because you're going to learn something that's going to help your trading immensely in the future by knowing what these lines represent. The 200-day is about 40 weeks worth of closing prices, whereas the 10-day is about 2 weeks of average closing prices. So if the average closing price of the last 2 weeks drops below that of the last year, that means there is not any institutional support in there. There isn't a line of pension funds and mutual funds and large players buying stocks that are beaten up on the S&P 500 and pushing us back above the 200-day. Here in December of 2015, you can see it, here is where one of the last two bearish crosses happened. And you can see price, came back and forth and tried to chop back and forth above and below here. But that's because we were heading into Christmas and it was close to the end of the year and nobody wanted to take a hit on their taxes selling into the end of December. So sure enough, the last day of December, you can see, was a big red day. And then we came into the year 2016 and sold off to the infamous Jamie Dimon bottom by the middle of February, down at 1810. So we were trading all the way up at 2140, 2150, and we sold off down to 1810, and that was a really breathtaking move back at that point in time. Here was the very last time it happened to us. The 200-day simple moving average cross was in Q4 of 2018, and that's clear enough and short enough in the memory bank here to remember what that was like. Here you can see, here was the crossing, here was the chopping going on, and then finally the rolling over and selling off. And here it was. Here is the the move from the high to the break of the 10 and the 200-day simple moving average. This would be about double. This would be about triple, and then there was a little icing on the cake, a little extra move down. And when I talk about our double and our triple down now at 2709 or so, we would be testing this area where the June low was last summer, and at 2367 or so is actually the actual move from our all-time high to the break of where the 10 and the 200-day simple moving average will cross now at 3051. A tripling down would take us all the way down here to back test these lows in December. And what's also interesting is that if we took a double down and tested and looked below the June low, look at what was happening in June of 2019. We had another 10 200-day simple moving average cross that was on deck, and it was fended off. And this is a great example. This is a perfect example showing you of that action to fend off that cross. It was a multi-day rally, little tiny bit of a pullback and no break of the 10-day, and a move up and no real break of the 10-day, constant support. And until we put in an exorbitant amount of time above the 10-day, was there any kind of a move allowed to come down. And these moves were all supported and defended at the 200-day simple moving average line. So that's the kind of behavior you have to see to know that you're getting this all fended off. So you can look back on a daily chart and look at what happened in 2018 and look at what happened in 2019 to sort of show an example of what is to come. We're going to either mirror what happened in 2018 or we are going to mirror what happened here in 2019. Okay? Hope that makes sense. So once again, if we were to double down our move from the 10-day, from the high to where the 10-day crosses down through the 200-day, a double down would get us down to 2709 for a look below the June low and a little more than 20% off of the all-time high. If we were to triple it down, we would come all the way down here to back test where we were back in 2018, as explained. Here is a backed out version of our roadmap, and you can see in order to get this fended off, we would have to come in on Monday, and we would have to make a move and close above the 10 and the 200-day simple moving average. The 10-day is going to cross down. It's probably going to be right around here at 30.28. This is a huge level to begin with. From the past, this is where we were topping out in July last summer and rolled over and had that big sell-off that lasted all through August, September, and most of October, and then finally at the end of October, beginning of November, we regained this 30.28 level. So our 10-day is going to be right down here. And if we come in and can move above 29.74, expect to move very quickly to 30.28, and then a move back above the 200-day, and look for a close back above the 200-day on Monday if we are going to set in motion a move to try and fend off what has happened here. If there is, another one of these failed rallies where we kind of take a look below 30.28 and fall back, and if we close again below 29.74 on Tuesday, I think that gives us confirmation to the downside. Yes, we might still have some more choppiness. We might go up and down a few more times, but ultimately we should be prepared that there is going to come a day where we come in and we are going to start selling off. We're going to break this low. We're going to head down to 27.09. And if that doesn't hold support, we're going to be heading all the way down, possibly as low as 23.60s on S&P 500. Okay, I guess that's it. I guess that's it for now. Hopefully this got you, got your mind all wrapped around what's going on. Please read or reread that article on the simple moving averages to understand that these are not lines on a chart. This is just a graphic that represents the average closing price of the S&P 500 stocks, of an average S&P 500 stock. And one thing right now that is bullish still is that the 200-day simple moving average is still rising. But if this comes to a day where it opens lower than where it closed the previous session, that means that it has flattened or it has begun to go down. And if this 200-day, if this 10-day is still down through that 200-day, when this 200-day simple moving average flattens and moves down, that is going to be the ultimate confirmation signal. That's going to be the kind of thing that the algos pick up on, and we have one of those days where the bottom just sort of drops out, kind of like what we saw here in February and in the last 2 days of trading there. Okay? Have a great rest of your Sunday. I hope I didn't depress you. If you want the market to go down, if you're in that camp or if you're in that mindset where you make a wish about how you want the market to go, I really wish you wouldn't do that. But if you want to see the market go down, you should be watching the trajectory of the 200-day simple moving average and keeping track of this bearish cross. And you should be looking for this pattern of 2 days in a row, turn to 3 days in a row, turn to 4 days in a row of closes below the 200-day. If you do not see this pattern, you need to get over yourself and stop thinking that I want the market to go down. The market's going to go up. You want to make money. You don't want to have the market just go a certain way. You want to understand where it's going and trade it and make money off of it. So if you don't see this pattern pull through that confirms us to the downside, no matter who you're following on FinTwit, having the power to understand this for yourself is the best way to make money, in my opinion. And that's what will give you that confirmation and that confidence to know that you're trading in the right way. Okay? Have a great rest of your Sunday. As always, good luck and good trading.